Unveiling the historical code and strategies of debt crises, my approach to navigating them. Introduction: why the shadow of debt crises lingers. The global economy is like a mighty ship, sometimes gliding through calm seas, sometimes battered by storms. Ray Dalio's debt crises, my approach to navigating them, backed by nearly 50 years of investment wisdom, uncovers the hidden rhythms of economic cycles. Why do debt crises flare up in cycles, and how do they shape our lives? Join us as we step into this economic saga to explore the logic behind crises and the tools to navigate them. Chapter 1: The core logic of the debt cycle. The economy mirrors the human body, with debt as its blood vital in moderation, deadly in excess. In Debt Crises, Ray Dalio reveals that the debt cycle drives economic activity. It comprises short-term debt cycles 5-8 years, long-term debt cycles 75-100 years, and super debt cycles. Using a template analysis, he breaks crises into predictable phases: debt expansion, bubble collapse, deleveraging, and recovery. Consider the 1929 U.S. Great Depression. The 1920s credit boom fueled a stock market frenzy, with ordinary people borrowing to speculate in a nationwide gamble. Dalio writes, debt acts like a stimulant, sparking short-term growth, but planting long-term risks. When managed well, debt fuels the economy like gasoline in an engine, driving progress. But over-reliance turns it into a ticking time bomb, hiding systemic dangers. Dalio compares debt to a stimulant, highlighting its dual nature. Moderate borrowing can fund infrastructure, education, or innovation, boosting growth. Unrestrained borrowing, however, sows the seeds of systemic crises. Post-World War II, the U.S. thrived in the late 1940s and 1952, with government borrowing fueling infrastructure and suburban growth, spurring demand for housing and consumer goods. This productive debt drove GDP growth, with debt-to-GDP ratios hitting about 120% in the early 1950s, manageable due to strong economic expansion. Yet, the perils of overborrowing emerged in the 1970s, as U.S. debt surged to fund the Vietnam War and welfare programs. The 1973 oil crisis sparked inflation, exposing the fragility of debt dependency. Dalio's analysis warns that debt's short-term boost must align with long-term repayment capacity to avoid a destructive spiral. Similarly, China's 2008 global financial crisis response included a 4 trillion yuan stimulus, funding infrastructure with debt to stabilize the economy. While effective short-term, local government debt soared, nearing 30% of GDP by 2020, posing future economic challenges. This case underscores the need for cautious debt expansion to avoid drinking poison to quench thirst. Individuals can learn to prioritize borrowing for future income growth, like education loans, over consumption loans to minimize financial risks. The 1929 stock market crash triggered a domino effect of debt defaults, leading to bank failures, soaring unemployment, and a decade-long economic slump. This reveals that unchecked debt expansion inevitably leads to bubble bursts. Unrestrained debt growth is like a flood. Once the dam breaks, devastation follows. The Great Depression shows how credit-fueled asset price surges masked economic weaknesses. In the 1920s, U.S. banks loosened lending standards, letting households and businesses easily borrow, inflating stock and real estate prices. Dalio notes, debt-fueled prosperity is unsustainable when debt outpaces income growth. In the 1920s, U.S. consumers used installment plans to buy cars, boosting demand. But many households couldn't sustain high debt, leading to defaults and a banking crisis. A similar pattern unfolded in China's real estate market from 2000 to 2010, with soaring loans and home prices doubling in some cities. Household leverage ratios climbed from 20% to over 50%, and local governments amassed debt via land financing. By 2015, some cities' debt exceeded 100% of fiscal revenue, pressuring future deleveraging. Dalio's template stresses that debt growth must match economic growth to prevent inevitable collapses. Investors can track household debt to disposable income ratios to spot market overheating. For example, Toronto's James Lee sensed a housing bubble in 2017, sold his investment property, paid off loans, and dodged losses in the 2018 market dip. His story shows that grasping debt cycle patterns helps individuals sidestep risks. At the heart of the debt cycle is the leverage ratio, or debt-to-income ratio. Dalio's data shows that when leverage exceeds thresholds like U.S. household debt hitting 100% of GDP before the 2008 subprime crisis, the economy enters a danger zone. He simplifies it with a model: leverage ratio equals total debt economic output. High leverage means debt repayment squeezes consumption and investment, sparking a vicious cycle. Picture Eric Hoffman, a middle-class American in 2007, struggling with the $200,000 mortgage on a $5,000 monthly income. His mortgage payments ate 60% of his income, and falling home prices raised the risk of insolvency. Such personal stories mirror macro trends, runaway leverage signals, crises. Dalio distinguishes productive debt, like business equipment investments that yield returns, from non-productive debt, like excessive consumption, which breeds risks. Germany's Siemens, for instance, used debt in the late 19th century to expand factories, fueling growth, a model of productive debt. In contrast, Greece's heavy borrowing for welfare in the 2000s led to the 2010 Eurozone debt crisis. Individuals should prioritize borrowing for education or skills, which offer long-term returns. Chapter 2: Historical Mirrors of Crises. Debt crises aren't modern inventions. History is our greatest teacher. In Debt Crises, Dalio examines 48 cases, from ancient Rome to today, revealing universal crisis patterns. Let's dive into 3 key examples. First, the 17th century Dutch Tulip Mania. In the 1630s, tulip prices skyrocketed, with a single rare bulb worth a mansion, as speculators borrowed to chase riches. The bubble burst in 1637, sparking debt defaults and economic decline. Dalio observes, speculative psychology magnifies debt risks, and emotion-driven markets are doomed to fragility. This shows that asset bubbles, fueled by excessive borrowing, are ignited by emotional investing. Bubbles form from human greed and market mania, with borrowing as the kindling. During Tulip Mania, speculators borrowed heavily, even mortgaging homes, to chase tulip profits, pushing prices to unsustainable heights. Dalio attributes this to the herd effect, where investors blindly follow trends, ignoring fundamentals. A parallel emerged in the 2020s crypto boom. In 2021, Bitcoin soared from $10,000 to $69,000, luring retail investors to borrow via credit cards or leverage platforms. Ignoring volatility risks, many lost big when the crypto market crashed into 2022, with Bitcoin falling to $16,000 and global losses exceeding $2 trillion. Singaporean investor Chen Wei borrowed $100,000 for crypto in 2021, losing 80% of his assets in the crash, sinking into debt. His story highlights how emotional investing amplifies debt risks. Dalio suggests building an emotional firewall with investment caps and stop-loss points to avoid chasing highs. Individuals can adopt this by setting clear investment plans, limiting borrowing, and regularly assessing risk exposure. Japan's late 1980s real estate bubble reinforces this lesson. Businesses and individuals borrowed heavily to invest in property, driving Tokyo home prices to hundreds of thousands of yen per square meter. The 1991 collapse spiked bank bad debts, leading to decades of stagnation. These cases warn that emotional investing and excessive borrowing ignite crises, making rational decisions vital. Imagine Amsterdam merchant Hendrik Vander, who borrowed his fortune for tulips, only to go bankrupt in the crash, leaving his wife and 3 children destitute. This personal tragedy reflects society's speculative fever. The second case is the 2008 U.S. subprime crisis. During the housing boom, banks loosened lending, letting low-income borrowers take large mortgages, while Wall Street bundled subprime loans into complex products. Dalio recalls, "I sensed trouble in 2006 due to sky-high leverage ratios." His insight came from tracking macro indicators like leverage. In 2006, he analyzed U.S. housing debt, finding household debt at 130% of disposable income, far above historical norms. This prompted his subprime crisis warning and Bridgewater's shift away from risky assets. His success stemmed from data-driven analysis, not gut instinct. From 2005 to 2007, U.S. subprime loans jumped from 5% to 20% of the market, as banks ignored borrower credit risks for profit. Dalio used a debt burden, metric debt repayment costs, as a share of income to pinpoint the crisis tipping point. In 2007, the U.S. debt burden hit 40, above the safe 30% threshold. Similarly, in the early 2020s, global corporate debt hit 98% of GDP in 2022, per IMF data, a historic peak. In markets like Turkey, corporate foreign debt exceeded 50% of GDP, with currency swings raising default risks. Turkish retailer Ahmet Yilmaz's business collapsed in 2021 as dollar-denominated debt overwhelmed profits due to high interest. Dalio's framework shows that tracking leverage and debt burden helps anticipate risks. Individuals can monitor central bank credit growth or global economic reports to gauge risks. In 2022, Chinese investor Wang Li, analyzing loan growth, cut real estate investments, avoiding market correction losses. Her story proves individuals can boost financial foresight with macro indicators. When Lehman Brothers fell in 2008, the global financial system teetered, but the Federal Reserve's rate cuts and quantitative easing sparked a beautiful deleveraging. Investor Sophia Carter, chasing high yields in 2007 subprime derivatives, lost 80% of her assets in the crisis. She regretted ignoring leverage warnings, a lesson in using macro indicators to avoid financial traps. The third case is the 19th century British railway bubble. In the 1840s, railway mania swept Britain, with investors borrowing to chase stock gains, inflating asset prices. The 1847 collapse triggered bank runs and bankruptcies. Dalio notes, technological innovation often sparks debt expansion, but without oversight, crises follow. The railway boom advanced the Industrial Revolution, but caused turmoil due to excessive borrowing. This shows that technological progress and debt expansion need careful management. Chapter 4 Paths to Deleveraging. When debt bubbles burst, economies deleverage, and Dalio identifies 4 paths: debt default, wealth redistribution, central bank money printing, and debt restructuring. Each path carries unique impacts, requiring careful balancing. In 1930s Weimar Germany, massive war reparations and hyperinflation led to defaults, economic collapse, and social unrest, what Dalio calls ugly deleveraging. Germany printed marks to cover deficits, sparking hyperinflation. By 1923, $1 equaled 4.2 trillion marks, devastating lives. In contrast, the US in 2008 used money printing and debt restructuring, with the Federal Reserve injecting trillions in liquidity and bailing out banks, paving the way for recovery. Dalio writes, "Deleveraging is an art of balancing inflation and growth to avoid societal rifts. Deleveraging is like walking a tightrope, balancing short-term stability with long-term health." Dalio stresses that successful deleveraging requires coordinated monetary, fiscal, and structural reforms to avoid runaway inflation or unrest. In 2008, the U.S. Federal Reserve pumped $2.3 trillion via quantitative easing, while a $700 billion bank bailout TARP averted systemic collapse. But this widened inequality, as loose policies inflated asset prices, leaving low-income groups behind. Dalio notes that beautiful deleveraging balances growth and fairness. Sweden's early 1990s banking crisis is another example. In 1992, a real estate bubble burst, spiking bad debts, but swift bank nationalization, debt restructuring, and fiscal austerity restored confidence. By 1995, Sweden achieved 3% growth, with unemployment falling from 8% to 6%. Greece's 2010 seconds deleveraging, however, was turbulent. Lacking monetary control, Greece couldn't print money, and IMF austerity slashed public services, sparking protests. Greek teacher Maria Pappas, whose salary dropped 30% in 2012, struggled, reflecting ugly deleveraging's social toll. Dalio advises governments to protect vulnerable groups early with targeted subsidies or job support to ease social strain. Individuals can monitor policy shifts like tax or welfare changes to adjust financial plans. In 2010, UK investor Alan Thompson, anticipating austerity, shifted to government bonds, dodging stock market swings. His story shows that understanding deleveraging paths helps find safe havens in crises. In the 1998 Asian financial crisis, Thailand's high foreign debt crashed the baht, but IMF-led debt restructuring and austerity restored stability. Thai entrepreneur Pavi Supa's factory failed due to dollar debt defaults but recovered the next year via restructuring and export adjustments. This shows that restructuring, paired with reforms, speeds recovery. How can individuals prepare? Dalio suggests tracking macro indicators like interest and inflation rates. In 2010, investor James Brandon, foreseeing Greece's default in the Eurozone crisis, moved to safe assets, avoiding losses. He read Bloomberg and Federal Reserve reports daily, tracking debt-to-GDP ratios and rates a habit to emulate. Individuals can follow central bank updates or economic news to time investments during deleveraging. Chapter 4: The Double-Edged Sword of Policy. Governments and central banks are pivotal in crises, but policies cut both ways. Dalio notes that loose monetary policies, like rate cuts or quantitative easing, stimulate economies but risk new bubbles. Fiscal stimulus, like infrastructure spending, boosts demand but may deepen debt. In 1990s Japan, post-real estate bubble, ultra-low rates and fiscal spending aims to revive the economy. Dalio observes, Japan's lesson is that policies treating symptoms without structural fixes lead to long-term stagnation. Japan's lost 3 decades show that over-reliance on monetary policy without reforms traps economies. Japanese entrepreneur Kenichi Takahashi, leaning on subsidies in the 1990s, neglected innovation, and his company failed. His case warns that while policy benefits tempt, businesses must prioritize competitiveness. In contrast, The US in 2008 swiftly cut rates, launched quantitative easing, and bailed out banks and the auto industry, stabilizing markets short term. Dalio stresses, policy must be precise, like surgery, not a random prescription. Precision determines policy success. Broad measures can backfire. In 2008, US quantitative easing saved banks and spurred spending via low rates, but it risked new real estate and stock bubbles. Dalio notes that effective policies target crisis roots, like bad debts or liquidity, not just flooding markets with cash. China's 2015 stock market crash response involved rate cuts and state fund interventions, but it didn't address corporate over-leverage, leading to 2016 defaults. Chinese SME owner Li Chang, benefiting from 2015 low-rate loans, failed to improve operations and went bankrupt in 2017 under debt pressure. This shows policy benefits need business reforms to last. Australia, in 2008, used targeted stimulus, like cash payments to low-income households, to boost spending while tightening bank rules, avoiding systemic risks. By 2010, Australia posted 2.5% growth, one of few developed nations to skirt recession. Australian retailer Emma Wilson used stimulus funds to expand inventory, boosting post-crisis profits. Dalio advises policymakers to pinpoint issues like surgeons, while individuals can track policy details to adjust strategies. In 2020, Singaporean investor Lin Jun, anticipating business relief, invested in tech stocks, earning 20% returns. His case shows that policy signals create investment opportunities. General Motors' 2009 $50 billion US bailout enabled debt restructuring and production upgrades, leading to a 2010 relisting, a policy triumph. Policy deeply affects individuals. In 2015, Brazilian advisor Carlos Ferreira, predicting rate hikes, shifted clients from stocks to bonds, preserving wealth. His strategy, inspired by Dalio, tracked policy signals like central bank rate decisions to adjust plans. Individuals can monitor budgets or monetary policy changes to adapt financial strategies. Chapter 5. Personal Strategies for Resilience. Debt crises hit not just economies, but personal wallets. Dalio's all-weather portfolio advocates diversifying assets to balance risk. He writes, "Don't put all eggs in one basket, but pick the right baskets." Investor Alyssa Morgan, following Dalio's advice before 2008, split her portfolio, 25% stocks, 40% bonds, 20% gold, 15% cash. When stocks crashed, her bonds and gold preserved her wealth. Dalio's formula is asset allocation equals expected returns risk diversification. This helps individuals weather market storms. Alyssa spent 2 hours weekly studying trends to adjust her portfolio, a habit worth adopting. Dalio also stresses cash flow management. In 2015, Brazilian entrepreneur Fernando Silva, foreseeing currency devaluation, prepaid dollar debts, saving his company. He reviewed cash flow monthly, ensuring 6 months of liquid assets. Individuals should control debt and keep 6-12 months of emergency funds. Dalio advises, liquidity is your life raft in a storm. Liquidity is a lifeline for individuals and businesses, with cash reserves cushioning shocks. Dalio emphasizes that liquidity management is a mindset, not just a technique. In 2008, many U.S. SMEs, lacking cash, folded amid order drops and credit tightening, with bankruptcies spiking 20% in 2009. Apple's $20 billion cash reserve in 2008 enabled R&D, launching the iPhone 3 and strengthening its market. Dalio's all-weather portfolio applies to cash, recommending 6-12 months of liquid assets for emergencies. In 2020, Canadian freelancer Sarah Davis, with a year's savings, sustained herself without high-interest loans during the pandemic. Her story shows liquidity as a crisis lifeline. Individuals can ensure liquidity by reviewing budgets and saving 10 to 20% of income for emergencies. Dalio also warns against relying on a single income source. In 2020, Chinese freelancer Jiang Wei added income via online education, weathering pandemic disruptions. His case shows diverse income boosts resilience, achievable through new skills or side ventures. Beware the herd effect. In 2007, U.S. realtor Rebecca Thompson, caught in market hype, borrowed for multiple properties, going bankrupt in the crisis. She regretted not thinking independently, following the crowd. Dalio warns, market sentiment is a tide, rationality is your anchor. Individuals can build judgment by studying finance, reading The Economist, or following Dalio's social media. Chapter 6: The Cultural Roots of Crises. Debt crises aren't just economic, they're tied to cultural psychology. Dalio sees consumerism and short-term thinking as crisis breeding grounds. Citing Daniel Kahneman's loss aversion, he notes people borrow to maintain lifestyles rather than cut spending. In the US, late 20th century credit card culture saw savings rates drop from 10% in 1980 to 2% in 2005. Dalio writes, consumer culture blinds us to debt's long-term costs. Consumerism traps people in seeking instant gratification, ignoring debt risks. Dalio, citing Kahneman, says humans overvalue short-term gains and undervalue long-term costs. In the early 2000s, U.S. credit card debt rose from 10% to 25% of household debt, with many racking up high-interest debt for luxury spending. U.S. retail worker Jennifer Brown, with $20,000 in 2005 credit card debt, saw payments eat 40% of her income, leading to bankruptcy. Singapore's mandatory savings plan Central Provident Fund fosters saving, with a 15% household savings rate in 2020, far above the US. This cultural edge bolstered Singapore's crisis resilience. Singaporean teacher Lee Xinyi used a 30-20-50 budget: 30 savings, 20% investments, 50% spending in 2019 to clear S50,000 in debt, regaining freedom. Dalio advises fostering delayed gratification by setting long-term financial goals to curb spending. In the 2020s, China's social media-driven minimalist living trend saw youths cut consumption and boost savings to face uncertainty. Shanghai worker Liu Fan, embracing minimalism, cut monthly spending from 8,000 to 5,000 yuans, saving 100,000 yuans in 2 years. Her story shows cultural shifts enhance financial resilience through financial education. Germany's saving culture keeps household debt below 60% of GDP, bolstering economic stability. German engineer Hans Schmidt, with disciplined saving and low leverage, stayed stable in 2008. His case shows cultural habits shape debt management. In 1990s Latin America, consumerism fueled debt crises. Argentinian housewife Maria Gonzalez, overwhelmed by 1999 credit card debt, sank during the economic collapse. Cutting spending and taking financial literacy classes, she recovered. This shows personal cultural shifts mitigate crisis impacts. Dalio urges cultivating delayed gratification. Swedish advisor Maria Lind's 50-30-20 rule: 50 necessities, 30% wants, 20% savings helped hundreds escape debt in the 2010s. Her client Anna Nord cleared 50,000 Swedish kroners in debt in 2 years, regaining freedom. This practical method suits individuals rebuilding financial health. Chapter 7: Early Warnings of Future Crises. Debt crises, like seasons, will return. Dalio's crisis template uses historical data to forecast risks. Global debt hit 355% of GDP in 2020, a record high. Future crises may stem from geopolitics, climate change, or tech disruptions. The 2020 COVID-19 pandemic saw governments pile on deficits to counter shutdowns. Dalio warns, pandemic debt could seed the next crisis. Pandemic-era debt surges planted new global risks. In 2020, global government debt rose by $13 trillion, or 15% of GDP. Dalio notes that high debt, paired with shocks like geopolitical strife or supply chain issues, could spark crises. U.S. federal debt to GDP rose from 100% to 130% in 2020, a post-we peak. In 2022, inflation forced Federal Reserve rate hikes, raising corporate debt costs and pushing SMEs into liquidity crises. U.S. restaurateur Michael Chen, borrowing to survive the pandemic, lost his restaurant in 2023 due to rising rates. This highlights pandemic debt's lasting risks. India's $2.6 trillion 2020 stimulus pushed government debt to 90% of GDP. Indian entrepreneur Pranav Mehta, relying on loans to expand, went bankrupt in 2022 amid rising rates and weak demand. Dalio's crisis dashboard recommends tracking debt growth and rates for early warnings. In 2022, UK debt costs spiked with rate hikes, rattling bond markets. UK investor Emily Hall, monitoring central bank announcements, shifted to short-term bonds, avoiding volatility. Individuals can use news or apps like Bloomberg or Reuters to track debt and rate data for defensive strategies. Dalio warns that tech advances, like AI-driven credit scoring, could amplify debt risks by enabling overlending. Individuals should cautiously use new financial tools, staying rational to navigate uncertainties. Italy's 2020 debt to GDP hit 160%, making it vulnerable to shocks. Italian entrepreneur Luca Rossi cut debt reliance and boosted cash reserves, weathering economic swings. Dalio notes tech-driven debt risks, like the 2021 crypto boom. Investor Ahmad Farid, borrowing for Bitcoin, suffered heavy losses in the crash. His story warns that new tech, while promising, can deepen debt traps. How to prepare. Dalio's crisis dashboard tracks debt growth, inflation, asset prices, and central bank policies. UK planner James Harper, using this in 2020, shifted client funds to defensive assets, preserving gains. His approach shows individuals can spot crisis signals with macro indicators. Epilogue: Mastering Crisis Wisdom. Debt crises, like tides, surge cyclically, but can be tamed. Dalio's debt crises: my approach to navigating them is both an economic masterpiece and a guide to thriving in uncertainty. By grasping debt cycles, historical patterns, policy roles, personal strategies, and cultural roots, we can stand firm in crises and seize opportunities. As Dalio says, crises teach us to respect economic laws. Whether investor, entrepreneur, or everyday person, mastering crisis logic is like steering the economic ship. When the next crisis hits, will you wait or act? Start today, finding certainty in uncertainty, and craft your own wealth story.